So I'm joined now by Oreoluwa Odetunde, Head of Research at Korea Asset Management, to review some of our top stories in more detail. Welcome to the show. Great to have you. So Japan, bond yields hitting an all-time high, demand weakening, 40-year bond yields actually. Is this a sign that we're seeing a global reallocation of capital?
I think certainly. So we're seeing, I mean, if you look at the concept of, a carry trade, it just really majorly means...
So for the benefit of our viewers, when you say carry trade...
Yeah, I was just going to explain what, carry trade really means. It just majorly means that, you're trying to harvest yield differential between two major currencies.
Yes.
And in this case, you're seeing a situation where people are pulling funds out of the Japanese market, which is typically the yen, and they're investing into higher yielding assets in other developed markets. So essentially, you're seeing a situation where they're just trying to take advantage of the higher yield environment in the other developed markets. And we know that, Japan has been chasing a negative interest rate policy since about 2016. And since the 90s, interest rates in Japan has actually remained quite low. So I think Japan has become that funding mechanism for a lot of emerging markets and developing market assets. And now that we are seeing a situation where inflation appears to be increasing, and also there is also concerns around the fears about the Trump trade tariffs, that is also affecting the yields in the fixed income space in Japan as well. So you are definitely seeing a situation where this Trump trade tariffs is bringing about a lot of conversations around de-dollarization, is bringing about a lot of conversations around economic decoupling and all of that. And we know that the Asian investors have about $7.5 trillion invested into the U.S. market, U.S. treasuries and, stocks as well, not just treasuries as well. So, I mean, if you start to see a reversal out, that might cause a global market rout, something similar like we saw, when, there were the initial announcements around the Liberation Day and all of those things.
Yeah.
So, I think another thing to also note is that we're seeing like, short-term funds that have majorly been backing those funds, that most of those investments we've been seeing in EMs as well as frontier markets. So, which means that, as interest rates start to go up, we'd also expect that short-term yields also start to increase.
Yeah.
But I think the important thing about the Bank of Japan is that the Bank of Japan has been, quite careful in trying to increase interest rates. I think that it also is also aware that the pressure that we are seeing in fixed income yields is not just driven by tariffs or inflation. It's also driven by the fact that the BOJ has also cut down on most of its bond purchases.
Right, great.
We've also seen that it has also cut down on, life insurance companies have also cut down on their bond purchases. So there's a structural demand weakness.
Yeah, sorry to interrupt you because we have like 5 stories
markets.
to get
yes,
through.
I get that.
I don't want us to spend too much time. But very quickly, just on this, what impact does all this have on Eurobond issuances of countries like Nigeria, right, on other African issuers?
Okay, so I think it's actually quite positive, because you would see that now global portfolio managers and investors are somewhat looking away from developed market assets. And even before we started to have, conversations around hiking interest rates in Japan and all of that, we have started to see a situation where, these global portfolio managers have started to view, most of the assets in developed markets as somewhat overvalued. So they've started to look away from developed markets. They've started to look at emerging markets. I mean, you hear them mention LATAM, let them mention Japan. I think Japan equities are starting to see more of the inflows from, foreign investors. So I think there's the concern about overvaluation in developed markets. So I think it definitely bodes well for, the emerging and frontier market assets as well.
Thank you. Great one. And let's quickly move on to another story.
Yes.
The ECB is saying that it's closer to reaching its inflation target. At the top of my show, we talked about the fact that a rate decision is imminent. I think the ECB will slash rates.
Yes.
I think markets are already responding quite positively. What's your take on that? And what impact will this have as well on emerging and frontier markets?
Certainly. So I think, we've seen very healthy inflation numbers from, the major economies in Europe. I think we've seen for the likes of Germany as well, we've seen inflation that had somewhat peaked at 10.4%. I think it's settling around 2.1% in May. So, I think these numbers are very good. And I think it's also in line with the ECB's projections about inflation. It expects that inflation will average around 1.7% in 2025 compared to around 2.4% in 2024. So I think definitely the ECB is most likely going to continue its easing cycle. I think what is most likely to continue to drive down inflation in Europe is that we are seeing lower energy costs, and we're also seeing a situation where there's still some tensions between US and China. So it's possible that some of those goods that should have been exported to the US is now rerouted to Europe, and if that happens, we might likely see China reducing most of the prices of the goods that it's supplying to Europe so that it could continue to supply them. And I think it's also finding a way to export disinflation into Europe. So I think that will have downward pressure on yields. And aside from that as well, I think we're also seeing a situation where, European inflation should still remain, quite stable. We think that, in terms of the monetary policy strategic review that, the ECB set in 2021, it had said that it is looking at inflation over time, like an average inflation rate. It's not necessarily looking at inflation on a month-on-month basis. So I think that, should we see temporary shocks in inflation, maybe inflation overshoots 2% or undershoots 2%, we might likely see that the ECB will still continue this easing cycle. It won't necessarily look to like just like you're saying, there'll be a 25 basis cut that will happen. We've already had three times rate has been cut already this year, and I think aside from the June meeting that we're also having, I think the next meeting there'll also be a 25.
So we're essentially likely to see an easing going forward.
Yes, going forward.
So just one more question on this. Is the ECB has said it's adopting a data-by-data strategy, a meeting-by-meeting strategy. So essentially, it's not providing any forward guidance. Giving that sort of strategy, it means that those in this side of the pond who watch ECB policy decisions need to be flexible because we essentially don't know the policy thrust. So tell us what this all means for many African countries who have issued Eurobonds and are relying on European capital markets.
I think it's definitely positive for them because, if you start to see inflation trend down, like I said, the ECB would start to cut interest rates as well. It will have a positive impact on yields that we're seeing for most of the bonds that have been issued by African sovereigns as well as, those of European counterparts as well. And that when yields are coming downwards, we're most likely going to see that prices will keep going upwards. So, investors will take advantage of that differential and it's very positive.
Fantastic. I think we can't take all the remaining three topics, so I have to just select one. Which Salesforce, Powell, or Nvidia? Which one catches your fancy?
We could take the Nvidia story.
So the Nvidia story, very interesting because despite this restriction on US-China chip trade, Nvidia's results were very impressive.
Yes.
So is it that that the geopolitical tensions don't impact the AI investment ecosystem?
No, they do. No, they do. I think what is going to happen is that it's the outlook, I think is the path going forward that is now going to be very uncertain, is where we don't know what, Trump is going to do in terms of, its tariff announcements. We've seen that there's been a reprieve of some of these tariffs. They were in his conversations. China and US were in conversations, but yesterday there was a reprieve, and we are seeing most likely next week we might start to see 50% duties on steel production. So I think it's very negative for Nvidia. We've seen that when we saw that their results being released, we saw that their share price increased by about 6%. It peaked around 6%, but you see that yesterday, the share price also fell about 5%. So there's that volatility, there's that uncertainty being priced into Nvidia shares. And you also notice that, during the analyst call, Jensen Huang also mentioned the fact that they are also expecting potential sales losses from China. It is benchmarking it around $8 billion. So, if that continues, if we, price that into the market and, it's also pricing in the fact that we are also having major competitors like the Huawei, who is producing chips in China and supplying the other big tech companies in China as well. So it's a major competitor, and if we continue to see pressure from competition in this way, we might continue to see downward pressure on the stock prices of Nvidia.
And it's interesting because I also think Nvidia's dominance might signal a decoupling of a tech sector decoupling from the US-China relations. But as you said, the results we're seeing is first quarter. And going forward, there might be a lot more volatility. Thank you so much, Oreoluwa. Great to have you on the show as always.
Thank you for having me.
Thank you.